A brilliant stock tip has one deadly problem. Millions of other investors are hunting for it too. So when a stock looks obviously mispriced, ask the uncomfortable question, what do you know that the market does not? And why has no one traded the opportunity away? Today, we test whether beating the market reflects skill, hidden risk, behavioral error, luck, or profits that disappear after costs. We will study one of the most important ideas in investments, market efficiency. This topic sits at the center of modern finance because it asks a very simple but powerful question. When we look at the price of a stock, a bond, or any financial asset, what exactly are we seeing? A security price isn't just a number on a screen. It is the market's collective assessment of future cash flows, risk, timing, uncertainty, and the return investors require for accepting that uncertainty. When investors trade, they are really exchanging opinions about the future. One investor may believe the future looks better than the current price suggests. Another investor may believe the opposite. The market price is where those competing views meet. A market is informationally efficient when prices reflect available information quickly and competitively enough that investors cannot reliably earn abnormal returns from that information after considering risk and costs. Notice the careful wording. Efficiency doesn't mean prices are always correct. It doesn't mean the future is known. It means that earning predictable, repeatable, risk-adjusted excess returns is difficult when many investors are competing to interpret the same information. So today, we will learn what market efficiency means, what it doesn't mean, why active investing is challenging, how behavioral biases may affect prices, and how investors can use these ideas in real portfolio decisions. Let's begin by clearing up a common misunderstanding. Market efficiency doesn't say that all investors are perfectly rational. It doesn't say that prices never move away from intrinsic value. It doesn't say that security analysis is useless. And it certainly doesn't say that no one can ever earn a high return. Instead, market efficiency is a statement about competition, information, and expected abnormal returns. An efficient market can still be volatile. Prices can move sharply when new information arrives. In fact, quick price movement can be a sign that information is being incorporated into prices. An efficient market can also produce very different returns for different investors. That isn't a contradiction. Investors who bear different risks should expect different returns. The key issue isn't whether someone outperforms once. Some investors will outperform over certain periods simply because outcomes are uncertain. The real question is whether the outperformance is predictable, repeatable, risk-adjusted, and large enough after costs. This is why surprises are so important. Prices respond to information because information changes expectations. But not all news is equally important. What matters most is the part of the news that wasn't already expected. For example, good news may have little impact if the market already expected it. Modest news may have a large impact if it is much better than feared. The central question isn't simply, was the news good or bad? The better question is, how did the news compare with what investors had already expected? Market efficiency is usually discussed in three forms: weak form, semi-strong form, and strong form. Weak form efficiency focuses on information contained in past prices, past returns, and trading data. If weak form efficiency holds, then simple trading rules based only on price history shouldn't reliably produce abnormal risk-adjusted returns after costs. This doesn't mean prices cannot trend, reverse, or appear patterned over short periods. It means that using those patterns profitably, consistently, and after realistic costs is much harder than it may appear. Semi-strong form efficiency is broader. It states that prices reflect all publicly available information. Public information includes financial statements, company announcements, analyst reports, regulatory filings, macroeconomic news, industry data, and many other sources. If this form holds, investors shouldn't expect to earn abnormal returns simply by reading public information that everyone else can also read. The challenge isn't access alone. The challenge is having a better interpretation, faster reaction, stronger discipline, or more efficient implementation than other investors. Strong form efficiency is the most demanding version. It says that prices reflect all information, including private information. In practice, this is best understood as a theoretical benchmark, because some information is private, costly to obtain, or illegal to trade on. These forms are nested. Semi-strong efficiency includes weak form efficiency, and strong form efficiency includes both. But we should treat them as benchmarks, not all or nothing labels. Real markets may be more efficient in some securities, less efficient in others, and different across time. To evaluate market efficiency, we must understand abnormal returns. A return isn't abnormal simply because it is high. A high return may be compensation for risk. A low return may be consistent with low risk, or it may reflect poor performance. To decide whether performance is truly unusual, we need a model of normal expected return. This leads to one of the most important ideas in empirical finance, the joint hypothesis problem. Whenever we test market efficiency, we are also testing the asset pricing model used to estimate expected returns. If a strategy appears to earn abnormal returns, there are several possible explanations. The market may be inefficient. The risk model may be incomplete. The strategy may be exposed to a risk factor we didn't measure. The results may come from luck, data mining, or omitted costs. Or the pattern may exist in historical data but be difficult to trade in real markets. That is why evidence against efficiency must be interpreted carefully. The practical investor lesson is very direct. Diversification matters because individual mispricing is difficult to identify. Costs matter because fees, spreads, taxes, research expenses, and trading costs reduce net returns. Risk adjustment matters because higher returns aren't proof of skill. Benchmarks matter because performance must be evaluated against the right standard. And discipline matters because emotional trading can destroy value even in a reasonably efficient market. Efficiency doesn't force every investor into the same portfolio. It asks every investor to explain clearly why their strategy should improve outcomes. Now let's connect market efficiency to active and passive investing. Active investing attempts to outperform a benchmark or improve investor-specific outcomes through deliberate decisions. These decisions may involve security selection, market timing, sector allocation, factor tilts, valuation views, or risk management. Passive investing attempts to capture the return of a market or benchmark with low cost and low tracking error. This distinction is useful, but it isn't absolute. Passive investing still requires important choices. Investors must choose the benchmark, asset allocation, rebalancing policy, tax approach, liquidity plan, and risk tolerance. These are real decisions. Active investing also exists on a spectrum. Some active managers make small deviations from a benchmark. Others build concentrated portfolios that look very different from the market. The main challenge for active investing is competition. When information is valuable, many skilled analysts, institutions, quantitative investors, and traders have incentives to find it, interpret it, and trade on it. Their activity pushes prices toward values that reflect available information. Costs make the challenge even harder. An active manager doesn't merely need to find attractive securities. The manager must create enough value before costs to overcome management fees, trading costs, taxes when relevant, market impact, research costs, and other frictions. So the key question is not, can active managers ever be right? Of course they can. The better question is, can this active process add value reliably after risk adjustment, after costs, and at the scale required by investors? If markets are competitive, why can mispricing ever persist? The answer is limits to arbitrage. Arbitrage means trading against mispricing. In a perfectly frictionless textbook world, arbitrageurs would immediately eliminate mispricing. But real markets aren't frictionless. Arbitrage can be risky, costly, slow, and capital constrained. This is very important. The existence of a mispricing isn't enough. An investor must be able to trade it, finance it, hold it, and survive the period before it corrects. There are several limits to arbitrage. Fundamental risk means that even if a security appears mispriced, real news can arrive and change its value before the price converges. Noise trader risk means sentiment or uninformed trading can push prices even further away from fundamental value before they move back. Short sale constraints can make overpricing especially difficult to exploit. Sometimes shares are expensive to borrow. Sometimes they are unavailable. Sometimes the risk of shorting is simply too large for the investor's mandate. Financing and margin constraints matter because losses can force an investor to exit before the thesis has time to work. Liquidity and transaction costs matter because large trades can move prices or require accepting unfavorable terms. Model risk matters because the investor may simply be wrong, and agency risk matters because clients may withdraw capital after short-term underperformance. So limits to arbitrage don't prove that prices are always wrong. They show why rational investors may not be able to correct every pricing error immediately. Behavioral finance gives us another way to think about challenges to market efficiency. Behavioral finance begins with a simple observation. Investors are human, and human judgment isn't always fully rational. But we must be careful. It isn't enough to say investors are biased. A useful behavioral explanation needs three parts. First, there must be a bias. Investors must make a systematic judgment or decision error. Second, there must be a price effect. The bias must influence demand for securities or the interpretation of information. Third, there must be a limit to correction. Arbitrage must be risky, costly, slow, or constrained enough that competitive investors don't immediately eliminate the pricing effect. Common biases include overconfidence, where investors overestimate their ability to forecast prices or interpret information. Overconfidence may lead to excessive trading, concentrated positions, and underestimation of risk. Confirmation bias leads investors to favor information that supports what they already believe. Representativeness makes investors rely too heavily on recent patterns or vivid stories. Availability and salience cause familiar companies, recent news, or highly visible events to receive too much attention. Anchoring makes investors slow to adjust when conditions change. Loss aversion makes losses feel especially painful and may lead to poor decisions after declines. The disposition effect leads investors to sell winners too quickly and hold losers too long. Herding occurs when investors follow others instead of relying on independent analysis. For portfolio managers, understanding biases is valuable even without predicting the whole market. A disciplined process can reduce errors in research, trading, rebalancing, and risk management. Market anomalies are return patterns that appear inconsistent with a simple efficient market prediction or with a particular asset pricing model. Anomalies are important because they force us to ask deeper questions. Is the return pattern evidence of mispricing? Is it compensation for risk? Is it caused by market frictions? Or is it a measurement problem? Common anomalies discussed in investments include momentum, reversal, value, size, and post-earnings announcement drift. Momentum refers to the idea that securities with strong recent performance may continue to perform relatively well for some period. Reversal refers to the idea that securities with extreme past returns may later move in the opposite direction. Value focuses on securities with low prices relative to fundamentals. Size focuses on return differences associated with smaller and larger firms. Post-earnings announcement drift refers to the possibility that prices continue moving in the direction of an earnings surprise after the announcement. But an anomaly should never be treated automatically as a free profit opportunity. Investors must ask whether the pattern is robust across samples, markets, and time periods. They must ask whether it survives trading costs, taxes, liquidity limits, and short sale constraints. They must ask whether the return is compensation for bearing risk. They must ask whether the pattern weakens after it becomes widely known. And they must ask whether the finding is the result of data mining or a particular research design. A strong investment thesis must explain not only what pattern appeared in the data, but why it should continue and why the investor can capture it after costs. When might active management add value? Active management is most plausible when the investor has a sustainable advantage and when the expected value of that advantage exceeds the cost of implementing it. The advantage may come from superior information processing, specialized expertise, patient capital, better risk control, lower costs, or the ability to operate in less competitive segments. Active management may be more reasonable in markets that are less liquid, less transparent, or less heavily followed. It may also be more useful when securities are difficult to analyze because cash flows, accounting quality, optionality, or capital structure are complex. But active management is less compelling when there is no clear edge, when costs are high, when turnover creates large tax or trading costs, or when the portfolio is mostly a closet index fund charging active fees. The efficient market perspective doesn't say active management is impossible. It says the burden of proof is on the active strategy. This also changes how we think about security analysis. The analyst shouldn't simply ask, is this a good company? The analyst should ask, is this security mispriced relative to what the market already expects? A strong business can be a poor investment if the price already reflects very optimistic expectations. A troubled business can be an attractive investment if the price is low enough relative to realistic future cash flows and risk. So the key distinction is between a good story and a good investment. Under market efficiency, the analyst must always ask, what is already in the price, and what is the market missing? Let's bring everything together. Market efficiency supports a portfolio view of investing. Individual security selection is difficult and uncertain, so investors should evaluate decisions in terms of total portfolio risk, expected return, diversification, liquidity, taxes, constraints, and the investor's objectives. For active portfolios, the important issue is how the portfolio differs from the benchmark. Active risk comes from those deviations. Measures such as tracking error and the information ratio help connect active decisions to portfolio outcomes. They help investors ask whether expected value added is large enough relative to the active risk being taken. Performance evaluation should separate skill, risk exposure, costs, implementation quality, and luck. A manager who earns a high return in a rising market may not have added value if the portfolio simply had more market exposure. A manager who underperforms over a short period may still have a sound process if the strategy is expected to experience difficult periods. A careful evaluation asks whether the benchmark was appropriate, whether returns were measured after realistic costs, whether taxes mattered, whether the period was long enough to separate luck from skill, whether hidden risks were present, and whether the process remained consistent. A reusable investment framework asks, what is the benchmark? What information is already in price? What is the source of edge? Why has competition not eliminated the opportunity? What risks are being taken? What are the full costs? And how will performance be judged? The final lesson is one of disciplined humility. Market efficiency doesn't require us to believe markets are perfect. It requires us to take competition seriously. Thank you for joining me today.